I'll be your instructor, your guide, your host as we talk about the stock and options market here. I want to thank you guys for coming in. My partner in crime, Markay Latimer, is actually traveling today and won't be available to be with us today because she's got a workshop in Dallas, Texas that you should go to. Amazing instructor, and she's stepping up to help me out. I was supposed to teach the Dallas event. Had an opportunity present itself that I really couldn't let go by, so I asked her if she would cover that event, and she gladly agreed to do so. If you're within driving, walking, or flight distance from Dallas, Texas, I would encourage you to get to that event and give you an opportunity to go out there and see somebody who is, without question, one of the premier instructors in technical analysis in America today. So I am Bill Corcoran. I'll be your instructor here as we move forward talking about the stock and options market. I'll take the opportunity to spend a little bit of time discussing the market with you guys. I'm not going to take a lot of your time here this morning, but we do want to talk a little bit about what's been going on in the market. Those of you that were in the lab this morning know that we already talked about it, and that talking about the stock market is what we do. That being the case, I am compelled to provide you with a disclaimer to let you know that I am not a broker, not a financial advisor. I do not have license to give you specific financial advice. That is not my purpose here at all. My single, sole, and only purpose in this and every single workshop that I do for BetterTrades is to provide you, the student, with an education that is general in nature and not tailored to any specific individual, even if I was to use your name in the course of the workshop. Also understand that from time to time I may use examples of real-time unfunded paper trades as a way to highlight, illustrate, and demonstrate the strategies I'll be sharing with you throughout the course of our time together. Those are examples only, and they are used only for educational purposes. All right, let's jump in here and see what we got going on here. Very nice, Bill. Jim says I can hear you. Good morning, Bill, and Lou. Good morning, sir. How are you? And Scott says hello again. And I mean, some of y'all, I'm kind of starting to think I've seen you somewhere before. So now that we've made it through the disclaimer, what do you guys want to talk about? I mean, I got some stuff, I got some ideas, but this workshop's not about me. This workshop's about you. Good grief. Scott sent a dissertation. Calculate performance on bid, ask prices and options at the time executed the fake trade. What do you recommend the way of setup? We do use similar stuff. Here's what I'm going to tell you. So Greg asking a question: How do I best paper trade? Right? How do I go through that process of paper trading? And the eSignal platform allows us to use paper trades as part of our education, right? And I encourage you to do the same. I encourage you to use paper trades as a way to learn, to grow, to improve your skills, and to test the strategies that we teach you guys. The whole reason that we do what we do is to teach you potential strategies that can be used in the market. You have to, of course, take into consideration the risk-reward profile, the amount of money at risk, the way that strategy works in your own trading. But if you should decide that you do want to participate in it, those strategies are what we're here to teach. So that being the case, you do need to practice trade. You need to practice with these strategies and make sure that the strategy works the way you understand it to work, and that things work out the way you want them to work out. And so for that reason, I encourage you to go through that process of learning and gaining the knowledge, gaining the information to be able to execute the trades. Paper trading is a great way to do that. So in the eSignal platform, we have the ability to execute all of our trades in a real-time environment using fake money, and that's what we do in the morning lab. I would encourage you to use the eSignal platform for your paper trading. All right, it does a good job of practicing, allowing you to practice those trades and keep track of them. John says, do y'all trade live in any courses or classes, or just paper trade? So John, let me come back here. None of us are registered broker-dealers or investment advisors. In other words, we do not have license to give you specific financial advice. I cannot tell you what to buy and what to sell, and that is on purpose. Could I get licensed and then be able to tell you what to buy and sell? I could, but I'll tell you this. If I am doing that, I do not believe that I am meeting my primary role as a teacher. I'm here to teach you to fish, not to give you a fish. And I want to stay as far away as I possibly can from even giving the impression that I'm here to give you trading candidates for you to make money off of. That's not what I'm here to do. If you want somebody to do that, I can give you a list of hedge fund advisors who are happy to take your money, put it into their account, and charge you 20% of the profits to do so. If you don't want to do that, then what we do is we use paper trading as a way for you to learn how to utilize the strategies. Now, I have no doubt whatsoever that there are students in our student body that actually use the information that we are using to teach, and they may see a candidate based on their own independent research and experience based on what they've learned from us and others to execute a real funded trade. Those would be savvy, knowledgeable, experienced traders who have the ability to look at a candidate and determine if it is in fact a candidate that they want to participate in. William, all right, good to see you. Good to see you in Boston as well. Jose says, better to learn to walk by ourselves. I think it is, and the other thing I think is important is that you do the paper trades because you've got to get the practice down, right? All right, so let's see here. Let me see what else. Is Markay's calendar Fred class still available on DVD? She did a calendar spread class, but I don't know if she ever recorded it on DVD. In fact, I know that she did not. So she did an online class, right? It was available on archive. That's what it was. And so, no, and would be the answer to your question. Now, the next question that you asked, does your massive passive income class cover all of her info? I tried to do justice to it, right? In fact, I learned a lot about calendar spreads from Markay, and when I put together my class called Calendar Cash Flow, which is the DVD set that we just recorded in Phoenix, Arizona, is available for pre-sale right now as we speak. In fact, if you jump on board right now, I believe we're even giving you a special price on that. So, Philip, if you get that, yes, it covers all the information that she covered, and it allows you to kind of get a look at the strategy, the way that I run it, and the things that we're looking for when we do it. So you could certainly jump on and get that. Greg says, is this Unplugged class which you were referring to when you mentioned the Morning Lab you do paper trading in, or is that something different? Greg, Morning Lab is a mentoring mastermind group that I facilitate every single morning. I hate to say that I'm an instructor, I guess that I am, but in that Morning Lab, I really am more of a facilitator. We get together every single morning, 4 days a week. We trade the open of the market with our paper trading accounts, and again, as I said, I am quite certain that there are people in there that have the knowledge and experience to evaluate the candidates that we're discussing for paper trades and determine whether they're right for them to use in their own funded trading, and if it is, I would imagine that they probably do so. That is not the purpose of the Morning Lab. The purpose of the Morning Lab is to teach, to educate, to mentor, to guide, to show you the strategies. In fact, I'm going to show you some here today that we may be able to use on stocks that have earnings. So the Morning Lab is something different. It is an environment where we also use paper trades. Where do I find the Morning Lab in the list of classes on our website? Well, now there's a question that I can certainly look at. Let's go to our BetterTrades website. So if you go into the BetterTrades website, you'll see that there is a store, right? And in the store, you'll find core curriculum, premium on location, and subscriptions. A lot of stuff in here on subscriptions, dedicated trader, e-signal, and so forth. This would be where you would get some of the information that you see. One that you might want to consider is the Trader Talk sampler platter, right, where you get Markay's Trader Talk, My Morning Lab, and Ron's Mini Trader Talk. I didn't even know we had this on here already. So in the store, you will find all of the products that we have available. One of the things that you will find in the store is that we have the ability to bring you into premium online classes. There's some stuff in here as well regarding some of the Trader Talks. For example, Markay's Trader Talk. The lab is just a version of the Trader Talk and is what we use to get you that education. So what I'm going to encourage you to do is to go make a phone call and give us a call and get hooked up with the class. It is a subscription. It's a Trader Talk subscription, if you will, and I'll give you the information on it now. Normally, the lab is $29.95 per quarter, unless you attend a live event, in which case we give you a significant discount of $1,000 and let you come in the lab for $19.95. Now, we now have a monthly subscription rate as well, so if you're interested in subscribing monthly to come and check it out, I would encourage you to do so and come in and kind of check out what we're doing, or if you just want to go in for one session, you can do that for $149. So some things that you can do there. As opposed to a dead event. Exactly, Mike, thank you. I said live event, and Mike said as opposed to a dead event. William says, nice to see you in Boston. Can you share some pre- and post-earnings strategies? I would love to. That's part of what we're here to do. Spend a little time with you guys talking about strategies, and that's what we do. Let's talk about one here because we do have a company coming out with earnings this evening. A little company some of you might have heard of called Netflix. Netflix, currently trading at $106.35. One of the things that we teach in the morning lab is how to go in and evaluate a company that has earnings coming up to determine kind of the maximum range, if you will, that the market makers or that the options market is implying the stock may move. So if we go in and we take a look at the at-the-money straddle, okay, the at-the-money straddle. In other words, buying a call and a put with the same strike prices. If we price out the at-the-money straddle, we get a pretty good idea of where the market maker is protecting himself from a maximum move in the stock price. So if we go in and we take a look right now at the at-the-money, let's see where we at. We're at 106.25, so let's call it the 106. $6.95 on the call, $6.60 on the put. So what are we looking at? About $13, a little better than $13, almost $14 is what the market is pricing in. The options market is implying a potential move of up to 13, a little better than 13, almost $14. Okay, does everybody see how we did that? We took the at-the-money straddle. And think about it, guys. What's going on here is the market maker has to protect themselves from a move in the stock price. So when a market maker comes in and he looks at this chart, yes, they get to look at the charts too. It's not just you and I. They give the market maker a chart, and he looks at it. And he looks at this chart, and he says, well, Netflix can be a pretty volatile stock. And as a market maker, he's going to sell roughly an equal number of call options to people who think the stock is going up and put options to people who think the stock is going down. By doing so, he is now exposed to risk. So what the market maker has to do is to balance his risk across the entire portfolio of call options and put options. So let's just take the at-the-money strike as an example. And at $106 a share, the market maker is priced in for roughly a $14 to the move to the upside, which takes us to about $120 a share. If the stock goes up to $120 a share, or the stock goes down $14 from 106, so 106 minus 14 brings us to 92. Across his entire portfolio of call options and put options that he has sold, the market maker would be protected from paying out net across that entire portfolio if he has priced in the options so that at the money option is expensive enough that it will not meet the break even if the stock moves less than this distance. In other words, if you went in and you bought a call option and a put option on Netflix, you would have to spend about $14 for that straddle. If that stock moves anywhere less than 120 or does not move below 92 tomorrow, you will lose money on that trade. You will. You'll lose money on that trade. So if we go in and we look at this, we say, well, I think the stock might go up, I think the stock might go down, I don't know which, so I'm going to buy a call and a put, and you buy that, the market maker has protected himself from a 14-point move to the downside and a 14-point move to the upside. He won't have to pay you. So we're basically going in and saying, look, it looks to me like the market maker has protected himself from a $14 move. Well, if that's the case, then it doesn't make any sense. Guys, I don't know. I mean, what do you guys think? You tell me. Is this stock pretty unlikely to move to beyond one of those two ranges? What do you guys think? Jose says, funny, it's gapped an average of $13 over the last 3 earnings. Brian says, I think it could. All right, well, Brian, given the information that Jose just shared with us that the stock has gapped an average of $13, not 14, $13, one direction or the other, is the market maker doing a pretty decent job here of protecting himself? William says it's unlikely. And not only that, Jose, those $13 gaps, were those gaps to the upside or to the downside? I mean, I already know, but let's see if we can get John taken care of. He's having issues with sound. 2 up and 1 down, Jose says. All right. Netflix has gapped up and it has gapped down. So as we take a look at Netflix here, let me just ask you this. Let's do this. Instead of, how many of you would agree with me that it would be foolhardy to buy a call and a put that are going to cost us a total of $14 when the market maker has priced in about $14 worth of movement? How many of you would agree that it would be foolhardy to buy that? And even if you just bought a call or a put, you would have about $7 at risk with a very high probability that you would lose that $7. That's $700. Brian says you could sell one of each. You could, but then you're exposed to upside risk on the naked call. Right? We don't like to sell a naked call option. Let me show you something here, and I'm just going to throw an idea out there to try to keep things fairly simple. There's nothing simple in the market, but I'm going to throw an idea out here. Just challenge your mind for a minute. Guys, what if I came out and I sold to the market maker, I sold to open, the 89 put option. If I sold the 89 put option, Bill says you can put a 30-cent stop on each. If it gaps over, your stop is going to be utterly irrelevant first thing in the morning, Bill. But what if I sell a way out of the money put? Let's think about it for a minute. Am I outside of the range that the market maker is expecting? Jose says, naked? Well, yeah, we're going to talk about that in a minute. All right, I sell the 89 put option. let's do this. Let's kind of draw this out. You now see it here on the chart, but let's do this. Let's go look at it in a drawing. I mean, you would agree that you are probably a visual person. You learn better when you see it than when you hear it. Right? Does that make sense? I know when I was in school, I learned things way better when I could see what the teacher was talking about than if I heard what the teacher was talking about. All right, so we've got a stock. It's trading at about $106 a share. We go in, we say, I would like to play a bullish, not necessarily bullish. I like to play a strategy that allows me to take advantage of these overpriced options. How about that? We know that the market maker has priced in a potential move down to $92 a share. And a potential move up to $120 a share. Well, if I come in and I sell to open, let's do one contract of the 89 put option. And right now, as you and I sit here and we discuss the possibilities, we discuss the strategy ahead of the earnings announcement, that 89 put option, let's go take a look. You see, because the at-the-money options are overpriced, all of the options are overpriced. The market maker is trying to protect him all the way, himself all the way through the option chain. And right now, ladies and gentlemen, I could sell that 89 put option for $1.25. I can sell that 89 put for $1.25. The stock is trading at 106. Let me help you out here. I am going to sell a put option that is $17 out of the money on Tuesday, an option that expires on Friday, and I'm going to bring in $1.25 for doing it. Some of you don't look all that excited. Let's review. I go in and I sell to open the 89 put option for $1.25. I'm bringing in $1.25 for selling a put. Am I outside of the range, the potential range that this stock may move? Now, obviously, there are no guarantees, and the stock may move more, and we'll talk about that in just a minute. But am I outside of the range? What if you said to me, Bill, I don't know, 89 is kind of close to 92. I mean, I know he's got $14 priced in. What if it moves $15, $16, $17? All right. Let's go back and take a look. Right now, today, ahead of the earnings announcement, I can sell the 87 put for about $1. 98 by 101, we'll call that $1. So if I sell to open the 87 put instead, we'll go further out of the money, and I sell to open the 87 put option for around $1. It's an option that expires this week. Am I well out of the range of what the market maker has priced in? I am. What is my risk? What risk am I taking by doing this? What have I done by selling a naked put? Greg says, yes, there's still a risk, but if you like the stock, owning it at 87 and having the capital to cover is not very risky. Rose says you're vulnerable. Okay, you're vulnerable to what? Scott says that they put the stock to you. Stock could be put to you. You may end up owning the stock. If it goes below 98, you own, you have it put to you. Actually, if it goes below, in this example, 87, right? If the stock goes below 87 and stays there, right, because it would be put to you at expiration. The stock goes below 87, it would get put to you. Brian says, you're risking that the stock could be put to you, but you could roll the put option out to the next month. Sure, that's a possibility. That would be one defense. Let me ask you this, guys. If Netflix gaps down, I don't know, to $87 a share tomorrow morning, what do stocks tend to do when they gap down a bunch? Trading at 106 today. We wake up tomorrow, it's trading at 86. What do stocks tend to do? They tend to retrace, meaning that it may go back up. As long as that stock is above $87 a share at expiration, I'm bringing in $1. Okay, I'm bringing in $1. If I do this on one contract, it's $100, is it not? I'm getting paid $100 on one contract. Now, that doesn't seem like a lot. I understand you guys aren't all that excited about it. But I want you to understand the theory here. The theory is that I'm selling to the market maker options that he himself has overpriced ahead of the earnings announcement, but I'm selling them outside of the range that he himself has identified as the potential range of movement for this stock. He's the one with all the financial advisement services. He's the one who has all the people who are telling him this is the deviation of the stock. This is where we think that stock may move to. And by doing so, I'm taking advantage of his research, his information, and taking what is a relatively low-risk opportunity to bring in $100. Now, there will be people who will say, yeah, but I can't sell naked puts. Yes, you can. Yes, you can. And if you can't do it yet, well, then it's just yet. Practice with this. Rose says, why not buy the 86 put to cover yourself? Okay, so the 86 put, Rose, if we were to buy that, let me do this first. Everybody's got the $100, right? Understand where the $100 coming from. If we go in and we buy to open the 86 put option, it will cost us some money, will it not? I think in this case it might be, Jose. It's something that I'm definitely looking at. Let's see how much that 86 put option is going to cost us. 86 put option would cost us 86 cents. That's kind of ironic. So we're selling one for 93, we're buying the other for 85. Let's say that we could get somewhere around that. This is going to cost us 85, which means that our net credit is 15 cents. We're bringing in 15 cents for doing this now bull put credit spread. Again, 15 cents is our credit, which is $15 on one contract. But we reduced our risk in the trade from essentially having to buy the stock for $87 a share down to buying the stock for 87, turning around and selling it to the market for 86. $1 is our risk. We're bringing in 15 cents. So Rose, if I'm going to do this, the 15 cents to me is not attractive enough. I would probably look at, instead of selling the 86 put option, I might look at the 85 or the 83, whatever the case may be, but it makes sense. Why not go in and do a put spread if you're worried about owning the stock, right? And if you don't like the stock, makes sense, you don't want to have to own the stock, so you could just do the trade the way I've lined it out here, where, again, as Rose said, you could buy the 86 or the 85 or the 84 or the 83 put option, giving you more credit because of the lower cost of the insurance. But let's talk about just selling the put for right now. If I sell the put, I bring in $1. If I do this on one contract, it's $100. Everybody with me? All right. What if the stock drops tomorrow and it drops all the way down to $90 a share? What will likely happen to the value of the put option if the stock price drops to $90 a share tomorrow? That put option that we sold for $1, what will happen to it? Greg says it will go up a lot. Rose says it will increase. Michelle says it will be more expensive. Well, if we sell a put for $1 and it becomes worth more, that's not a good thing, right? We would be $3 out of the money. Anybody know what the average price of a $3 out of the money put option on Netflix is with 2.5 days to expiration? On a normal week, what does a $3 out of the money put option with 2.5 days left to expiration typically go for? Anybody know? More or less? Anybody want to guess? Exactly, Stephen. Well, it's not zero, Bobby. It's still got some value because there's 2.5 days left, right? Which $3 out of the money. The value of this put option, historically, $3 out of the money is about $1. So the stock will have dropped $16, but the option price will either remain the same or it may actually go down. Let's say it goes down to 85 cents. Why would the price of this put option drop even though the stock price dropped? Daniel's got it. Greg says, is it because time value changed significantly? No, the time value has only changed 1 day. The time value has gone down, but it has not gone down because of a loss of available time. Stephen says, volatility drops. Lois, how are you? Lois says implied volatility will decrease after earnings. And that is exactly what's going on. Guys, right now, let's go look at it. The implied volatility of the 87 put option is 185%. The Vega, which tells us how much that option price will change, given a 1% change in implied volatility, is about 1.5 cents. Meaning that if this implied volatility number drops back to more normal levels, a Wednesday, we know where the stock is going to be, we've removed the unknown factor, if you will, of earnings, that implied volatility will likely return to around 45%. That is a reduction of 140 percentage points. 140 percentage points times 1.5 cents per 1% move is going to be a drop, a reduction of this option price of about $2.10. In other words, guys, this option price, in this case the 87 put, let's say we were talking about the 89 we talked about earlier, if we're selling that right now for $1.13, that entire $1.13, most of it is likely to go away if these implied volatility numbers return to somewhere near normal, around 45% tomorrow. Michelle says, is the best time to do this the same day as earnings to get the highest premium? Yes, Michelle. So if we're looking to do something like that, guys, this is just one strategy, but the idea of going in and selling a naked put that is outside of the normal range of what the market maker is expecting is a strategy that a lot of people use. Now, where do you get burned on this? If the stock goes below $87 a share, you end up owning the stock. So let's talk about that. Let's go there, because a lot of times the best way to deal with the boogeyman is to look under the bed and find out, well, he really isn't all that scary. If you do this on one contract, you're bringing in $100, you would have to buy 100 shares of the stock. Yes? Stock. Let's just say that the stock at expiration is at $86 a share. Stock goes down to $86 a share. At expiration, you're going to have to buy $100 of 100 shares of this stock. Correct? All right. Let's go there for just a minute. That is $8,600 that you're going to have to spend. $8,600 would have to come out of your account, correct? Does everybody agree? Is my math correct? How much will I have to spend to buy that 100 shares of stock? How much will I have to spend? How much money will come out of my account to buy those shares of stock? Ah, interesting. Okay. I have to pay $8,700, do I not? Right? I agreed to sell the stock for $87 a share, which means that I actually have to spend $8,700. But because I brought in $1, my spend is not 87, it's 86. Does everybody see that? At this point, how much have I lost? When I go in and I buy that $8,600 worth of stock, how much have I lost on the trade? Because I'm going to have to buy it. I'm going to have to pay $87 a share, but they paid me $1 to do the trade, so I really only need to pay $8,600. How much money have I lost? How much am I down? I'm not. I haven't lost anything. If I have to buy the stock because they put the stock to me on Friday, I have to buy the stock for $86 a share, effectively my purchase price, and I own the stock. Michelle says, until you sell the stock for a loss, you have not lost. Well, let me ask you this, Michelle. If that's the case, if they put the stock to me at $86 a share, could I theoretically turn around and sell it for $86 a share? Could I do that? I own the stock. Could I sell it? Yeah, but it was put to you at 87. All right. You bought it at 87. They paid you $1. Your purchase price is 86. Yes? I sell it for 86. How much have I lost? I haven't lost anything. And how much money do I have to have in my account to do this? Well, let's first talk about what if they, because people will tell me, well, you got to have $8,600 in your account to be able to do that trade because you got to be able to buy the stock. Really? How much money would it cost me if this stock is put to me? How much money would I have to have on hand to buy the stock? Michelle says $8,600. But William says, hang on a minute. On margin, you would only need to have $4,300. I could buy with $4,300. So if it was put to me, $4,300 would cover my purchase of 100 shares of Netflix, which I could then sell, or I could sell covered calls, or I could let it rally and then sell it. So the most I have to have in the account to be able to do the trade if the stock is put to me is $4,300, and to sell the naked put, all I need to have is 20% of the strike price. Depending on the broker you're using, it could be 25%. So let's go 25% because that's easier. 25% of the strike price plus whatever premium I'm bringing in this case, $1. That is the margin requirement for a naked put. That's also not how you spell premium. There's an M in there. What is 25% of 87? $21.75 for those of you that are wondering. How much premium did we bring in? $1. $22.75 would be our margin requirement on one contract. We would need to have a margin requirement. We would need to have $2,275 to do this trade. Now, if the stock is put to you, you've got to have the $4,300 to be able to buy the stock, but you could turn right around and sell the stock. Now, let me go here. You got $2,200 margin requirement. You have a put option that you have sold that is literally, what, $19 out of the money? Guys, I like this setup because it is a high probability setup. Yes, I get it. I'm only bringing in $100. But this is where you practice. This is where you learn to do this. Because if you've got an account that's big enough, could you do this on 1,000 shares, 10 contracts? Let's say you're trading in a $100,000 or $250,000 account. Could you do 10 contracts on this and generate $1,000 of profit if the stock stays above $87 a share? You see, I'm taking the other side of the trade. I'm thinking differently. I'm doing things differently than everybody else. Everybody else is out there trying to figure out how to make money in a down market. We're in a bear market, and everybody's freaking out. Oh, my gosh, how do I make money in this? And I'm over here thinking, you know what? I know that Netflix has earnings coming up, And I know that with Netflix having earnings coming up, I could sell put options on Netflix that are way outside of the range that even the market expects that this stock would move $14 a share. If I sell a put option that's $19 a share out of the money, I have a high probability setup, and on one contract, even in a relatively small account of, let's say, $10,000, I'm able to do the trade. Mike says, how again do we determine the potential range that the market maker has priced in? Mike, that is based off the at-the-money straddle. The at-the-money straddle. Craig says, do market forces affect option prices? Like there's a lot of demand for options, or there's lots of third-party selling puts, for example. So if everybody comes in and everybody starts selling put options, will that affect the price of the put? Normally, yes. Ahead of earnings, probably not. The reason that it won't is the market maker is going to base the pricing of the out-of-the-money option, which is all time value, entirely on his risk relative to the price of the stock. So in this example, the market maker comes in and he says, I'm going to sell an option to you. I need to protect myself from you. I need to protect myself from paying you. So I'm going to price that option so that I don't have to pay you. The vast majority, let me just ask it this way. Do you think most people in the options market buy options or sell options, Greg? If you take the entire world of option traders, do you think most people buy those options or sell those options? They are buyers. The market maker will protect himself from the biggest part of the herd. He tolerates people like us because we are the knowledgeable, educated minority. What are most people going to do on Netflix? Most people are going to come out and they're going to buy a call or buy a put, or worse yet, buy both. The market maker knows that. He's going to protect himself from them. He's willing to do business with people like us, the educated minority, because we represent the cost of doing business. Guys, this is all stuff that we teach and we talk about at our live events. Just did one in Boston. Markay's got one going on this week in Dallas. Get to the live events. This is where you learn this stuff. Get involved in the morning lab and the Trader Talks, because this is where we talk about these things over and over and over again. You've got to get involved in this stuff. Get the DVDs where we talk about these strategies. I am going to sell the 89 put option to the market maker for $1.10 in our paper trading account. So those of you that are in the lab, this is what I'm doing. I'm going in and I am selling right now for $1.10 the naked put to the market maker. If this stock, Netflix, announces earnings tonight, and they will, and the stock goes up, I will make $1.10. 20 contracts, I will make $2,200 if the stock goes up. Let me do it this way. If Netflix goes up, I will make $1.10. If Netflix goes sideways, I will make $1.10. If Netflix goes down to the anticipated range of $92 a share, I will make $1.10. If the stock goes down to 87.90, I will break even on the trade by having to purchase the stock, turning around and selling it at break even, or hanging on to it for the potential fill of the gap and be able to sell it at a higher price. So in this case, I am selling a put that allows me to go in and profit whether the stock goes up, sideways, or even if it goes down by less than, in this particular example, Let's call that around 107 that we're trading at right now. So 107 down to 89, $18 move. Stock moves less than $18, I will get to keep, by expiration, I will get to keep the $2,200 I just sold to the market. Questions on that, guys? Is this a little different way of looking at trading in the market ahead of earnings? Just running some numbers on this. I actually have some fairly advanced market probability, option probability analytics and tools that I use. There's roughly an 85% probability of a successful trade here. Greg says, in your morning lab, do you keep a running paper trading account? If so, how has it performed over the past few months? I'll give you one example, Greg. Last week in the markets, how many of you guys noticed that the markets went down last week? Anyone notice it? A couple of you? Okay. Just a little bit, right? Just a tick. Yeah, the market went down last week. Last week, just to give you an example, we put on Friday, we closed out a number of positions in the morning lab that we had put on earlier in the week on Monday and Tuesday. Those positions were on Priceline and Amazon primarily, although we had traded Spiders, Apple, and Facebook as well. And all told, by the end of the week, in our paper trading account, we had closed out over $250,000 of profit in 1 week. Now, every week's not like that. Some weeks it's only 100,000. Again, paper trades. Some weeks it's just a few thousand. Right? So do I keep a running count? It's not about a running count. It's about you learning the strategies. Do we do fairly well in there? Sure. But again, like I said, my goal is not to give you candidates. That's not why we do what we do. We practice with the candidates so that we have something to discuss, so that we have something to talk about, so that I'm able to illustrate and demonstrate the strategies that I draw out on the board. But those strategies are no good if you can't actually do them in the real world, right? So we do them in the real world with fake money, and in our fake money account, we added about $250,000 profit just in the trades that we closed on Friday. We've been in them for almost a week. Margaret says most of the money comes in through puts. Must be the dominant strategy. Margaret, are you talking about in the lab? Because we've made trades with 100,000, 200,000, 300,000 in calls as well. Okay. The dominant strategy are the strategies that work, right? And I would say that most of what we do are swing trades off of moving averages, 3 to 5 day trades, and trend trades that might last anywhere from a few weeks to even a year. All right. So, guys, there you go. That's what we've got going on. Playing Netflix here by selling out of the money put options outside of the range that the market maker anticipates that we may see a move. We're willing to buy the stock down there at those prices. $89 a share is an attractive buy price for me on Netflix, especially if I can just get rid of it right away. And so that's where we're going to be looking to set it up. Demetrius says, Markay's in Dallas all by herself. Do you have any idea what she'll be teaching specifically? So here's the deal. Markay will be teaching the Next Step workshop, right? So our Next Step workshop is, I'm sure she'll be showing you some of her strategies, some of the things that she does, and I would encourage you to get there. We'll let you sign up for Dallas. Call us, Demetrius. Call the 800-676-4410, and we'll be happy to get you signed up there. Greg says, how similar is what you do in the morning lab to the way Markay trades? I am a product of the product, Greg. I am a student of BetterTrades just like you. I started out in all likelihood the same way you did. I came to BetterTrades because I saw a TV commercial and I got excited about trading in the stock market. And I thought to myself, you know what, I can do that. So I went in and I learned to do that. And I did exactly that. I learned to trade in the market. And through trading in the market, I came across Markay Latimer, who was one of my first mentors, one of my first instructors. I followed her classes. I bought her DVDs. I attended and paid to attend her live workshops. A couple $1,000s that I would spend to attend her live workshops each time. Went to those workshops and became a student of hers, learned from her, and so I'll let you decide. How similar do you think my strategies are? Similar, right? Now, I obviously have my own strategies and tweaks that I have learned through a decade of trading in the market very actively, and that is something that I can say because I do provide documentation to prove that. The government requires us to prove it when I say something like that. So yes, very similar with my own, let's just say, twist. Okay. Dennis says, is the San Antonio event still on for March? I believe it is, Dennis. Lois says, Bill, thanks for a great class in Boston. Enjoyed it very much. Thank you, Lois. I appreciate you guys coming in here and spending some time with me. I look forward to seeing you guys at a live event. Those of you that are in the Dallas area, get there. I know Markay's on her way right now. She's on a plane headed that direction. Get in there. Cindy says, we're going to miss you in Dallas. Well, I'm going to miss you in Dallas, too, because I won't be there. I appreciate the opportunity to spend some time with you guys. Look forward to doing it again in the very near future. Until then, ladies and gentlemen, I wish you all the success in the world. Godspeed, God bless, and we'll talk to you guys at the next live event.